Hello guys, and glad to have you on board again today. This is going to be TL number 6, and we're just going to add up onto the previous one, which was basically introducing you to the speculative area of the third range boundary. And today is basically like a part 2 of that previous video, in which we're going to dig into first assessment into risk management. So this is definitely the easiest way to get you into this shadow area of shaded gray areas. Okay, because risk management is all about getting into these shaded gray areas instead of just black and white answer to any rational questions investors are asking themselves, like whether they should get in or out. It's pretty much how much in or eventually how much out, which is the only rational question that a smart investor is doing. So this is what we're going to try doing today in the most rational way, trying to get you into this perspective of avoiding black and white answer and getting into the shade of gray. Okay, so it isn't easy, and what we're going to be doing today is really scratching the surface, really doing it into which I think is the most appropriate context in terms of rules. This is where the rules are the simplest ones to get, but this is also where we've made it clear that a lot of other things will get to impact your active trading results, and mostly emotional impacts and psychological management, which we're going to be dealing with into probably what's going to be the next videos of this series. So today, introduction, but definitely one of the best possible way I think to get into understanding what risk management is about, not being overcomplicated either, just giving you the guiding lines and some guidelines, some follow through to understand what a strategy is all about, how to formalize something into a process that you're going to get to follow each and every time, even though this perspective isn't something that is frozen. It's definitely just the structure is frozen, and you're always going to follow the same path, but the answers you're going to get out of this path will be modulative, because that's exactly what risk management is about, doing always the same fucking thing, but never getting the same answers, okay? So you're never going to find two trades that are going to be similar in terms of risk management. So this is all about measuring this and figuring out how aggressive we need to be with some trades, how less aggressive we need to be on some others, or eventually those who don't even meet the minimum level requirements to just get into a trade, okay? So we'll see all about that, like considering it, putting a grade, a note, all right, from 0 to 100. We're going to try figuring out which risk level this current trade is. And is it worth taking it? Because any rational numbers we're going to get below 50 just makes it less profitable for us. At least the risk is fairly no limited. So if it's below average, let's drop it. There's so many trading opportunities. So what the fuck are we going to get into a trade that has irrational ways of risk managing? So we're going to take the best ones, okay, among the best ones, but just being above 50 doesn't mean they're all equal. Let's consider a 90 is going to be real great. Going to 100 is going to be fairly rare, in which you get the perfect conditions. And even though being 100 doesn't mean guaranteed outcome. I hope you do understand that thing, okay? It's just the perfect trade is very rare. So we're going to navigate into sufficient level to trigger, but most of the time insufficient to go perfection. Okay, so it's navigating between perfection and sufficient enough. Okay, so we're going to try navigating these things, considering this 0 to 100. It's basically we're going to take above 50, we're going to require above 60 to have better quality, and we're going to drive and trigger the trades between 60 and 90, because very rare cases scenario in which we get to the perfect signal in which everything lines up almost perfectly. Okay, so it's not going to be perfect, and you're going to need to understand how to slightly bend the rules, but always having rules to allow you to bend those rules. Okay, so this is what I'm going to be teaching you today. We're going to use a PowerPoint as a support in here, so just makes things a lot more educational, I guess. So today, as it is more technical, as it is truly technical stuff, we'll get into PowerPoint. Of course, risk management certainly isn't going to be explained in a 30 to 40 minute video, so it is an introduction. Most of risk management progression is just made by trading. So we're going to do, and I'm going to teach you most precise risk management in the live education purposes, sessions, whatever, all of those live condition trades or replays or daily prospective, daily forecasts, that this is where you'll see actually what risk management is about. So, okay, today is really the tipping top of the iceberg. Lots of what really is all about is underneath the surface, and you'll get to understand all about it later on. enough introduction, straight into this PDF. Oh, sorry. PowerPoint. Okay, so first of all, quick reminder of what the pattern is. I hope you do understand and do remember what the major elements of last perspective was. It's basically you have a 4-step thing to understand, and basically just freaking print that out into your brain, because this thing is just going to be frozen. Okay, this is the minimum guidance to get the speculative area. First of all, trend. Step number 1. Okay, step number 2, wait for the reverse. Okay. Step number 2.5, reversing this motherfucking context. If you just reach out to it, it's not going to be enough. You need to reverse. Step 3, pulling back to the opposite context. That must be this time facing the trend, okay? Uptrend means negative context is required to get out there and retrace to this negative context, okay? Step 4 is requirements of minimum Fibonacci retracement, at least 61% if you have decent odds to figure out that the bearish trending range is at play in this example in here, which is totally the case. And in that perspective, 61% will be okay, and you'll be able to trade inside the context. If these requirements are not met, or if there is too much hesitation, whatever, if there is any doubt, just go for the normal range, neutral range structure requiring to trade above the context, and 76% as a minimum area for risk management. Okay? This is something that you need to freaking print into your mind. These things will never change. Those rules are the basic structure to get the speculative area. Okay? That being said, today I had an interesting question from someone who's been looking at yesterday's perspective and had a shadow area, which is totally understandable. So let me be clear about that. Okay? Let me add up on yesterday's perspective. This guy were basically saying that, okay, if the first shot is made, like this was one of the examples in the PDF manual, if the first shot is made, but not enough Fibonacci retracements, do we actually print out? And how can they be a second third range boundary later on as the Fibonacci requirement is met? But this time, the context has been reversed. All right, let me just pause that and bring back this chart actually. Yeah, it is this one. And basically the question was surrounding this area, okay, in which, remember, this is not a third range boundary because it doesn't require the 61% retracement. But the actual user's question was, then how can it be out there as the context is now bullish? And this is something you need to understand, because of course that was somehow subjective at that point, and this is why you asking question when you have any doubt is absolutely crucial. That's what the Discord is all about. When something isn't clear, without enough explanations or whatever, if there's any doubt, just ask me out. Sometimes I don't make things perfect and I don't think about every possible questions you might have, and therefore if you don't say them out loud, I can't necessarily figure all of them out. So this one was really interesting because I understand the perspective. The rule is reduced reversed context, so how the fuck can this be a third range boundary? Well, it is because the pattern is a step by step. It's an incremental step. As you get to validate the first step, the next one can take on later on, okay? So the process is trend, reverse by reversing the motherfucking context, and retrace to the context, and wait for Fibonacci's. So as this is an then thing, it is, okay, I've got my trend, I've got reversed, okay, I made new highs, so still trend, I need to reverse, I reverse, I need to pull back to the context, done, I need the fibs, not done, so I'm just waiting to get the fibs. Even if getting to this fib will once again reverse the context to the upside, as long as I don't make new highs, I'm still looking for the third range boundary. Okay, so this is just a tiny little shadow area I just wanted to clear out first before we actually pile up today on risk management. Okay, so just a side note, quick thing. So let's go back to our perspective in here. All right, here we are. So here is our third range boundary because the pattern is met. So as you get into the speculative area, or which actually I recommend you to do, is just to get into touch before we actually get the signal, okay? But the process is going to be use the alert system. So if you do it well, you're going to put the alert when you reach back to the resistant context. So you're going to be triggering the alert right in here, which means the signal will come later on, which gives you normally plenty of time to review informations first. So first things first, scroll back in time to verify all the informations backward. Do you have enough Fibonacci's? Yes. Have you reversed the context? Yes. Have you been preceding a trend? Yes. Okay, in that perspective, that's okay. Most people tend to read the pattern this way, okay? I suggest when you go real-time trading, trying to figure out whether or not you're going to take a trade in here, okay, you're going to say, okay, I've prepared for these third range boundaries, so if there's an alert triggering, then that means I pre-done the job. So I just need to verify information. So I just verify, scrolling back in time. It's really a mindset that you need to get. Most people tend to read market from left to right. Professionals do it from right to left. So get used to professional behaviors. That's always going to be a better job, okay? So review informations first. Then when it comes to, okay, everything's fine, I'm into my risk management area, I've got my signal, so I'm going to measure the quality of this signal. Like we said, is it above 50? Yes. Is it at least above 60 so we can trade? And afterwards, is it closer to 90 or closer to 60, in which I'm going to modulate how much money I'm going to allocate for this trade. So in here, here's how it goes. After reviewing the information from right to left, you're going to switch to the bottom. But before doing it, there is still a little bit of information you need to gather on the chart area itself. And this is really important to understand, that if you immediately jump down there, you might be missing quite a lot of information. Because in here, the algorithm detected a signal. Oh, congratulations, it detected a bearish range context, which is exactly what you've detected as well. So this is great. That means you and the algorithms both see the same thing, which is kind of great. That means an automatic system sees that the conditions are met. You also see it. That's very great. It's kind of cool. So this itself is a good sign. Indicator sees something, you see the same, great. That's a good thing. It improves the notation. I would say we go right up to 75 out there. So that's cool, but that's not enough. Let's look at other informations. Sometimes you'll get the context alert. Not good. Context alert means you need to freaking have a look at the higher time frame. Eventually you might have, or you might be on the range into the higher time frame, which is one of the common mistakes people do. So remember, you don't trade range inside bigger ranges, okay? So if the higher time frames triggers a context alert, this is a red flag. You're probably missing an information. So this is one of the many things you're going to gather out of the chart area. Another thing you can get is those breakout patterns, because remember that cycles is included into our range management, or into our management at all. And therefore, those informations are plotted on the charts. It has been made this way to avoid getting too many informations in here. So just make sure you don't miss those information. Have a look at the short term only, okay? You have a look and you focus your eyes on this thing, and you have a look at whatever happens, okay? Is there a price okay? Is there a context alert eventually? Is the trend channel enough sized compared to the context? Because sometimes you just get a teeny tiny trend channel that is barely the width of a context ribbon, and in that perspective, you know, risk is real down the corner, not enough volatility. So all of those pre-requirements normally automatically detected by the algorithm that says, all right, maybe there's some risk you're not seeing. Okay, have a look at the potential cross signals. All of those things will be used at combining all the informations we need to measure the risk. And as you cleared all the chart area, scroll down, put down your eyes into this area. As you're in the speculative area, the signals matter. Anywhere else, they don't make any fucking sense. I know a lot of people who are getting to use my indicators without proper knowledge, and they basically have their eyes attracted to this because this is where there's so many information, so they tend to believe that this is where the shit happens. This is where the magic goes on. This is where the guy is good at trading. So I'm going to read that thing and I'm going to read the market with that. So they do it the totally opposite way in the way I do it. They're gonna read from left to right, and they're gonna read these things first, trying to make sense out of it to understand how it reacts on price. Absolutely dumb way of using my stuff, and it's definitely not going to be profitable. I would even say that seriously is going to increase your risk taking, putting you far into red. So that's not how it works, and it has never been meant to work this way. So use the tools properly. It's just like getting into a racing car without having a permit. So Jesus, driving license comes first, okay? So it's exactly what we do here. So read from right to left. Focus your attention on this to make sure you don't miss an information, and only then scroll down to the signal to see if something has triggered, okay? And then in here, it's really a black or white. Is there a signal, yes or no? First question you ask yourself. In here, yes. Second question, what type of signal is that? In the indicators in here, I'm not going to go into the gradients of how good a signal is. All of this is explained in a PDF manual, and that would take way too long getting down this road. So read the PDF manual. But what you need to understand first is that there are three types of signals. The gray signals, the colored signal, the blue and red, and the dark gray colors, okay? Which are squeezing patterns, exit patterns, and all the rest is a gray. Taking profit, gray dot, divergence pattern, all of those things, okay? So the gray patterns are okay in ranges. They are called average or averagely low level of signal quality. But they're going to be okay in a range. Why? Simply because we already limited the risk quite high with the chart area, okay? We required 76% or at least 61%, and in some specific case with the 61%, we are going to require some specific signals, okay? So when we do deal with a possible bearish range context, which is the case in here, we're going to use different risk management. We're going to talk about that later on, okay? Though in here, I've got a signal. It's okay, I've got my fibs, I've got everything I need, I can trade. So before trading, I know that my average note was 75 because I had my personal forecast. I see the indicator sees this as well, pretty great, okay? So I'm measuring my signal, actually taking profit isn't very good in here, so I would lower my expectation from 75 down to 65, okay? Still okay, but I'm definitely not gonna go with a big position sizing, more or less a tiny one in here. But that's not all about it. If I want to measure my risk more precisely, there are far more other tools I can get. First things first, I'm going to scroll back in time from right to left. So the first element you might be looking at, if you want to have a more precise reading, have a look at the second range boundary signal, which means anything that happened in between, pointless. Is this bear signal meaning something? Damn it, I'm getting too close to understand how the market works. Jesus, okay, this is pointless, this is pointless, this is pointless, pointless, everything is pointless. This isn't. This is where something happened, so this is where the risk management played its game. So, what's great with past analysis is that these trades, you don't have to take them. They're way too much complicated for you at that point, but you can still read what happened back then. It was a taking profit pattern with a divergence, as we didn't make new low. Don't forget that the divergence patterns sometimes are not detected, okay? So in here, just the taking profit. So actually, the taking profit you have might not sound that bad because that's exactly what reversed the bulls. So as the bulls profit took, market reversed. So maybe as the bears, or maybe as now the bulls might be profit taking, might be causing the reverse as well. So not that bad actually. I would say the quality of the signals to the upside says, all right, I'm going to rise my previous forecast back to 70. I was 65, but actually this signal doesn't sound that bad compared to the signals of my opponents. So as we go in equal party out there, I'm rising my quality back to 70. Okay, now let's get back to the first signal, the one of the guys, last time the guys like me traded. So how strong were they when they reversed the upside trend to neutralize it, okay? So they had a taking profit pattern with a squeeze, which is a gray signal, and there is a dark gray signal, and they have been putting a divergence on top of that. So three signals: taking profit pattern, divergence pattern, and squeezing pattern. So all of that tend to say, in terms of sentiment, they've been quite buying a shit ton previously. As we can see, prices have been surging fairly high. So it feels like this really has been an exhaustion pattern. The bulls really pushed way too far, and therefore they caused their own reverse. So it really feels like too much buyers. All right, let's reverse the shit. So I would say the bears weren't that strong, so we're going to keep numbers at 70. That doesn't increase or decrease the risk. We just see that the bulls have gone too far. So it definitely increases the probability for a range to be totally at play, okay? So yeah, we've done another layer of risk management. We just increased back from 65 to 70 with this thing, and we can still do something about it. If you want to go further down the road, you can use cyclical analysis to filter out. And in that perspective, you're going to have a look at the major cycles. How did things go from wave 1 to wave 2? How did things go from wave 2 to your current area, which is a speculative wave 3. You still don't know if it's going to be there, but you're speculating on the fact that it's going to be there. That's the job, okay? So what matters is that what happened in between, you already have printed. So you can study this. And then you can also study what happened in the year. Same thing goes on. Don't study left to right, study right to left. So first things we're gonna study is what happened recently. How did we go from the bottom to where we are right now? And then we're gonna compare it to how we went from the first to second. And we are going to get an assessment of how bullish versus how bearish. And we're gonna be able to compensate our assessments of risk, but not in a, I feel like this is got whatever bullish bearish, really using rational information. And we're always going to use the same things. That's what makes it relevant. If you're changing the stuff every once in a while, that doesn't work out, okay? Always the same things. Look at the signals, okay? Make your weighting regarding the signals. If you want to go further down the road, use cycles, okay? So how to properly use cycle? This is where I recommend to use the trend sine wave, okay? This is something you can use as the indicator setting. Double click on the indicator and you'll be able to see the settings in which you can activate trend sine wave, okay? And that will show you how the trend waves lead you to where you were. And you can see in here we have gone in two sets of waves, okay, two oscillation. The trend sine wave, you might not necessarily be able to see this one unless you really have a good eyes, okay, but this is this step line in the background, okay? So we can see two sets of waves, definitely followed by price. How did we manage those waves? First wave has gone pretty bullish. It has managed to make a breakout, then kind of a short-term consolidation, two sets of waves, and a final impulse, less ample than the first one. So we can see that they've released all the energy to get out of the first bearish signal, but then we're really losing strength, and just as a tiny little wave in here, they're already profit taking. Oh man, the bulls are really weak. Okay, that's the first thing we can say. Bulls are weak. They defended themselves into the first wave, but they're really lacking some strength so far. So yeah, good sign for us. But we need to see what happened before, all right? We need to measure one versus the other. It's not just, okay, this one is great, I'm going to rise the number. If this one is great as well, then that doesn't improve anything to my thing. So I'm going to study this. How did the bears react? Okay, so the bulls have been buying quite well. We know this because regarding the signals we had, totally type of exhaustion signal. So the bulls have gone too far and they've caused their own reverse. What do we see in between? Oh man, this one is a straight line, one cycle to the downside, and oh, there's an intermediate speculative area detected on a trend following opportunity, which had a signal. Oh man, we fucked the bulls in the process. So obviously, if you know how to read trend following perspective, you would know that this one was total bullshit and definitely not something to trade. But you also notice that there was probably some folks who got out there anyway, and they've been fucked. So that's great. That means in the process, we fucked a few bulls, and that's great. Though it's not perfect, but we fucked some bulls. And the bulls' reaction later on was pretty weak. So I would say, yeah, back to 75, folks. 70 up to 75. So even if we have a not that great type of signal, we're still going to have a decent trade out there. We're not going to go freakingly expensive type of trade, but an average 1% risk taking. I would say that's totally appropriate in here. It's an average risk taking. It's not low, it's not high. I would say in this range perspective, you're going to go up to 1.5% risk taking. 1.5% capital risk taking, and when the trade's really risky, you're going to go down to 0.5%, which makes an average 1% risk taking for mixed feelings 75 kind of level. Okay, so we've got our answer. All right, it's really what this is all about: gathering information in a pattern, in a process. Follow the goddamn thing. If you do it randomly, then that means a lot of risk can pour in. If you want to make this thing consistent, you need to understand the process and to activate that process anytime you are risk managing. Let me just sum up the core information. What do? You first things first, gather informations in the nearby area. After confirming from right to left that the pattern is definitely at play, of course. And then what you do, scroll for information, eventual context, whatever, all the things that can rise or decrease the risk management, okay? Then you scroll down to the signal area to see if you've got a signal to risk manage, okay? That will tell you that you can trade, but you can trade doesn't mean how much I trade. This is the reason why, if you have the time, it's always great to have made your risk assessment prior to that, okay? So if you're lucky enough to have the alert triggered before the signal itself, then you have this intermediate time to make your review instead of doing it at the last minute and rushing things up and doing it wrong, okay? Because of course, as you get to learn, you'll make mistakes if you're under pressure. As you get experienced, this process, I do this in less than 20 seconds. You're going to take minutes to do this because you're going to review a shit ton of stuff. You're going to make sure you're not forgetting something. Processing will take time, but as you go on, you'll get better at it, okay? Anyway, moving on, otherwise it's going to be a freakingly long podcast. So then, as you assess your signal, if you want to risk manage slightly better than that, look at the signals of wave 2 and wave 1 and compare their one to another. If one is significantly better than the other, you can either increase or decrease your risk assessment. Then you can eventually, if you want to go further down the road, measure the same thing using cyclical activity, and I recommend you to look at the trend sine wave to make sure your cycles really are meaning something. If in here as well you see some imbalance between bulls and bears, you can adjust the risk management as well with this. End of the story. After that is done, you should know approximately how much risk you're willing to take in here. If you've got an appropriate signal, get in. Simple as that. Okay? So it might sound simple when it's said. It's not that easy when you're going to put it into motion. It's going to take some time. You're going to make mistakes, but you're going to have to progress with that. It's always all about it. Don't blame yourself when you don't make things perfect the first time. No one does. But you get to learn this thing, and as you get familiar with it, it's going to become automatic. You're going to do it faster and faster until it actually gets totally natural to measure risk at each and every fucking given time. But don't go down the mistake of trying to make sense of market price movements in intermediate areas. Signals only matter when they are in a risk management area. Okay? So as you don't know how to highlight these ones in real time or how to trade them, lucky you can study them afterwards. Okay? So that's the reason why I start with the simplest trade. We're going to take care of these risky trades later on. Okay, moving on. Second thing is, real quick on this one because I already actually talked about it earlier. You've got two different things, okay? The normal neutral range boundary and the trending wave and the trending range. So as we said, this little thing in here in the PDF manual says you're going to need a trending signal out there. So remember what we said about the trending signals. Trending signal is a color signal. But it is not necessarily going to be absolutely mandatory. It's just that in order to trade 61% in the context, you're going to need these trending signals. But if you don't get it, like we said, I'm going to teach you how to sometimes bend the rule. If you don't have a trending signal, you need to have at least a signal. It's not, you don't trade naked. You need something. But if, for example, you've retraced 76% instead of 61%, and you have a range signal, a gray signal instead of a red one, that's okay. I would say the 76% is far more than enough to reduce the risk you're taking of not using a trending signal, okay? More importantly, without teaching you the rules, most of the trending pattern require a level of retracement that is lesser than 75%. So this is the reason why if you go right up to 76%, you're likely not going to get a trending signal, okay? So in that perspective, ranging gray signals are going to be okay, okay? But requires 76% instead of 61, okay? Second thing out there, if you get a risk limitation on the chart, like for example, a cross, a breakout, that can help. If you have a signal, even if it's gray, right next to a target, okay? Even if that's not a trending signal, I would say okay for a 61% retracement. But same things first, if you go 76%, that's more than enough. Any signals will work out this way, okay? So for trending range, you need, of course, the things we said previously. You need to fuck up the bull's context in here, eventually breaking a support in order to be able to trade in the context. Otherwise, you're going to wait for prices beyond context, okay? But in this case, in terms of signal, if you want to trade 61% instead of 76%, trending signal required or a target, okay? Otherwise, if you don't have the trending signal, wait for 76% retracement. You can still trade inside the context, but needs to be 76, okay? I hope you do understand that thing. Another really important thing, you wait for the fucking confirmations, okay? The confirmations are the little triangles on the algorithm. If you're using third-party indicators or whatever, just make sure you have a confirmation signals, like breaking a short-term moving average or whatever, but define a true rule that you're going to follow every fucking time, okay? That's absolutely mandatory. You don't trade just because the momentum has gone overboard. You need to see either this is, I don't know, candlestick patterns or things like that, but you need to have something that triggers and confirms that the price is reacting, okay? Multiple options out there. I'll leave you down the road finding your own patterns, okay? But if you're using my things, that's the triangle that you need to get, okay? Then, of course, saying things first if you want to figure out, but we also figured this one out. You need to study how strength was the relative first to second range boundary movements to figure out if you go this way or this way, but we've already been talking about this one. And finally, if there's any doubt, take this one because, of course, this one is a slightly more risky option. So yeah, any doubt, go for this one. All right, so just as a quick sum up in here, if you go for the downside range or the trending range, or you can go bullish, of course, if those things happen, you need a specific type of signal. This is just an introduction in here just to show you that, okay, just between those two range, a specific signal is required for one of these contexts. When we'll get to far more advanced stuff like trend following, counter trend, we're going to need some very, very tight level of signals out there. And what we're doing today is kind of an introduction to what's going to come later on in a much more complex perspective, okay? So get familiar with this thing. Know that some pattern requires some types of signals, but this one, fairly easy as a type of rule. It gets way more complicated later on. All right, finally, I think we should spend a little bit of our time getting into an example, into a market. So let's go down this road. This is basically the example of what we've done previously. Let's assume that we've triggered a trade with the 1% risk taking. Then what do we do next? I mean, we've got the information, we triggered a trade, we take a 1% risk, then you're not going to leave me just with that, okay? So of course, I'm going to leave you with an appropriate trading context, how to manage the position as it's going on, because risk management is not just taking a trade and figuring out how much, is how you're going to manage the shit as it's open. So here's I go. And in here, I've been taking a trade that didn't go well. I've been taking a trade that actually ended up with a stop loss because, I mean, when things are fine, they're fine. There's nothing to manage, okay? But anyway, what you're going to be doing in here, just like you do in the process of measuring and figuring out how much risk there is with the trade, you're going to have to learn a process on how to manage the open trade. And it's not going to be the same for every possible context, but for ranges, this is fairly easy. I'll give you a set of rules. You take them, you can eventually modulate them when you get really familiar with the strategy, but this is a fairly solid baseline for everyone out there, okay? So the first things you're going to be using is how to define the stop loss sizing. Okay, that can be a very tricky question. Some people say, all right, I feel like I should do this or this, or this is not how it works. You need to make things rational. So take the trend channel sizing, make it easy. Okay, you get to enter the trade in here. The trend channel size is that. Okay, put a stop loss of this size. It's okay. Most of the time, that will give you a fairly appropriate size for your stop loss. End of story. That isn't that complicated. No, I'm kidding. Of course, there are some bend the rules type of stuff. At some times, you're going to get a very wide trend channel, which means you're definitely not going to pay such a stop loss. When the stop loss is more expensive than the expectable target, okay, then in that perspective, you're going to have to bend the rule. But only in this case. In here, this is a bearish trending range. Your stop loss is there, and your target is going to be below the previous low point and below the context. So your expectable target when you take the trade is in here. Oh man, okay, no problem. In here, we don't have to tweak the stop loss. It's going to be fine. But in some rare cases, you're going to have a trend channel so wide that the expectable target is going to be less than the stop loss. You don't do these things. So you're going to have to bend the rule in those specific cases. You never risk more than what you can get. So in that perspective, you've got two choices. The first one is you divide the stop loss by 2, which means you take half the trend channel for the sizing. But if you do this, you take half the position sizing accordingly. Okay, so you divide the expected position sizing by 2. You're narrowing the stop loss, therefore you're taking more risks. You're going to need to reduce the risk by sizing it divided by 2. Okay? Option number 2 is you stick to a risk-reward ratio of 1-to-1, which means if you ever get to trade there and your maximum expectation is there, you can just not put any stop loss further away than the 1-to-1 ratio. Okay? So that's the case, and specifically for neutral ranges in which, okay, 76% Fibonacci is going to be your target. So if you enter there and your target is there, you can never use a stop loss bigger than this expectable target. Okay, the 76% Fibonacci is drawn from wave 1 to wave 2. Okay, so it's still normally the Fibonacci's from the range boundary. Okay, then anyway, down to risk management. Once you go to the trade, you got two options. Sorry, two options. The first one is either you're going to get validated or invalidated. What does that mean? Anything more than just either a price early reacted positively or absolutely not. And in that perspective, this is really a three-way gang. The price can go sideways upon your risk area. All right, you just wait. You've got nothing else to do, nothing better to do. Prices keep pushing further away, or price validates. What you're going to be using in order to validate or invalidate is the trend channel. Okay, when prices retrace down to the trend channel, is going to be your validation state. If prices go sideways, you don't give a shit. If prices were to accelerate and close on top of both the context and the trend channel, you would say, man, something doesn't go right. Prices are accelerating as I'm supposed to sell. That means either I've done something wrong or the market doesn't even care about the area and I'm probably the only one selling out there, which means you're a naked seller and you better have to get the fuck out. Okay? So in this perspective, when you get invalidated, it's up to you to decide. You've got multiple options. You can set the target at break even. So just in case there is a lower shadow candle, you can be taken out. No losses, you basically got in and got out at the same price. Or you can decide, okay, you know what, I've been putting a stop loss, risk is part of the game, they can try to invalidate me to eventually reintegrate later on. So you're just gonna do nothing and either let the stop loss being triggered or eventually reaching out your validation later on. Okay, but when you're selling, reaching out the support trend channel is your validation. That means you need to do something in here and to risk limit. So many options out there, and there is kind of a guideline thing into the PDF manual for those who are using my indicators of stuff you can put in place depending on your risk assessment. If you want to have an aggressive risk management or a low risk or more of a moderate approach that gives you take 25% profit, put the stop loss at break even. This gives you patterns to follow, guidelines. Okay, the best case scenario, of course, is to adjust that to every given trade. If you have a very risky trade, take a low risk management. If you have a low risk trade, take an aggressive risk management. This is how you can modulate your potential rewards. Okay, next step is going to be context as a median for a confirmation. If you get to close a candle below 50% context, means all right, you've confirmed the trade and you need to do and to perform a second risk management. Okay, absolutely necessary that you do this. Okay, and in that perspective, if you combine all this and kind of make the perspective of what this trade has been all about, it has been entering 1% risk with a stop loss in here. Okay, prices reacted very well depending on the risk profile I decided to take. Either I'm going to be taking a profit or putting the stop loss in here and taking no profit, or maybe just a 25% profit taking, whatever. Let's say in here I took 25% off the table, which is likely paying for my stop loss, and I just put the stop loss out of the market top. All right, and I wait for further information. As I go in here, I get close to validation. Some people might argue that we didn't close or whatever. In that perspective, let's say that we've decided to act anyway, but not that much. We didn't profit take anymore, as our target is pretty far and we want to maximize the gains, but we just put the stops at break even. Okay, we decided to just risk limit. Jesus. Okay, sorry about this. Secondly, okay, prices move on. They've reached out to the 76%, which is the normal range target, but we don't give a shit. We have a bearish range context, so here's our target. We do nothing out there, okay? Prices somehow rebounds out of this, kind of range a bit, wait. Oh man, we get another signal in here. That's the algorithm detecting another bearish ranging bearish range context. So we get the alert, we look at the signal, it's just a divergence. We say, oh man, okay, that's actually in my side of risk management, so I'm just going to leave the trade open because it can surge to the downside, which is exactly what it does right after the pattern triggers, but rebounds on the trend channel and breaks both the trend channel and the context. Fuck it. Have to study the thing, We don't miss the chart information. We do have a breakout pattern. So we're breaking the context, okay? We're breaking our entry price and we're breaking a bearish context in here. In this perspective, we definitely have the answer to our question. What the fuck is going on? We need to get the fuck out. The range has changed its structure, okay? We sold, it was supposed to be a bearish range, we had everything we needed to, we actually reached out the target for a neutral range and that ended up being the low point. So this is one of the cases in which even if you had everything needed to have a bearish range, it ended up not to be, and it created an ugly triangle. And how do I know that? Just because I used some simple rules, always the same. In here, I know that the range changed its structure from a bearish range potential to a neutral range. I still have 25% profit taking in the pocket, and I'm out at break even for the rest, which means I was wrong with the range in context, but I still made a little bit of money. And I still get the very valuable information that the range has changed structure, which is something we're going to use in trend follow. So information will give us money either right now or later on, but will help us anyway into risk management, into just other and more complicated contexts we'll deal with later. Information is priceless, and in there, we got a valuable information and we still made a tiny little profit in the process, even though we were wrong. So this is how risk management works. It's not about being right. It's about limiting what happens when you're wrong. When sometimes you're going to even make money being wrong, that's pretty great. And I would say in this perspective, if you've traded this thing just like that, people would eventually say, man, you were too bearish. No, actually, you did your job. You tried to figure out what the market did. You just didn't got the right word. You just didn't got the right context, but you followed your guidelines. Your guidelines were supposedly giving you more odds and chances to go for a more bearish structure, ended up not to be, which gives you a valuable information for the future, but actually ended up taking your stop loss. That's what this is about. I think after this example, we've got more than enough, and it's already 40 minutes in, so I'm going to switch right down to conclusion, kind of summarizing up all these informations we have shared right now. So, yeah, let's get into conclusion. All right, this one has been a long one, but I'd rather like to go into too much detail rather than not enough. And let me be clear once again, we're really scratching the surface in here. We're going to have a lot more real live trading applications in which we're going to use those rules and you're going to get more familiar with them. Like I said, it takes from 6 months to a year to actually get to understand these things. So yeah, if you don't get it just right now after a 40-minute video, that's absolutely normal. We'll get to it as you get familiar with it. Anyway, before you actually get to put this thing into applications, you need to fully well place the speculative areas. So the first thing you do in your progression, learning the third range boundary, is learning how to properly plot them in the charts. So practice, practice, practice. Don't trade first, practice. Okay, how do you do that? You first of all try to figure them out into a chart, looking at historical plots, and try to figure out if you can see all of them. The goal in here is not to miss them, okay? And more importantly, just try not to invent some that doesn't exist. As you think you got it right, you can make your exercise reviewed into the Discord, post them into the general analysis channel, and people will review them for you. That's definitely the best way of learning the patterns safely without trading this. Letting them, you plot them on a chart, you let people review them and tell you whether you missed something or created something that doesn't exist, okay? They review the things for you and you get to learn from your mistakes. After you passed on historical chart assessment, you're going to have replay, which means you're going to put yourself into real-time market conditions, but you're going to control time. You're going to play pause or stop, all right? You're going to do things the way you want, and you're going to put yourself into real-time conditions to kind of incentivize your eyes to get familiar with what it looks like into real-time conditions. As you start to be good enough with replay, you're going to get into opening a fucking account and getting to trade these things for real, okay? But you got me right, okay? You definitely don't take big position sizing. You start right at the minimum. You're going to take 1 micro contracts right up to eventually 2 when you think you have a very nice signal. But that's it. You don't take risks because you don't want money out of this. You just want to feel emotions and learn to control them slowly but steadily. So you're going to start with this tiny position sizing. And as you start feeling comfortable, and I'm talking about weeks, not days, several weeks afterwards, you're going to start rising slowly but steadily the exposition. If you ended up taking a big loss because of bad money management, things like that, emotions got in, Just slow down, go back and rise again later. Okay, that's how it goes. If you traumatize yourself, step back and do it again. Okay, as you get familiar with this pattern over 6 months to a year, means normally you're at full exposition, which means when you see an opportunity, you're taking 1% risk capital, whatever, you get familiar with this. At that point, you understand the psychology, you manage your psychology, you probably understood the basic of risk management, how to modulate your exposition into trades, which means you're ready to go for trend follow. And at that point, we'll get into the real deal, what actually makes money into the market, how we gather information from range to make them profitable into trends, all of the real stuff. Okay, so be patient, it's really long, and if you try to make it faster, you're certainly not going to make it better. That being said, a quick recap out there, okay, this is what you need to understand into this perspective in here. Really understand that this is a process, okay? The process has a simple set of rules. Don't try to read market from left to right, just like every noob is doing. Every professional reads the market first and foremost at the real-time area, making sure you don't miss an information. Later on, backplot and read back in time from right to left. And then as you get that, make the link between up and down, okay? Speculative areas, signals they triggered, and try to balance information one versus another, bulls versus bears. And if you see an imbalance between the two, then you can either rise, increase, or decrease the cursor of risk taking. That's what this is all about. I think this is more than enough. See you guys into live applications, whatever, in which we're going to use those rules. But at least in this one, I hope that I made them as clear as possible for you to understand what the process is all about. And last but not least, use alerts. That's the basic thing of using algorithms. If you're paying for those algorithms, use the benefits of them. Even with trend channel, these things will work out this way. But if you just look at real-time charts into areas that doesn't even matter, definitely going to be hard for your impatience biases and fear of uncertainty. So really put a frame to your strategy, okay? Use alerts from context to context. You have automatic context detections on the algorithms. Use that. This is very, very advantageous for you, okay? That being said, see you guys into the next video. I think we're going to talk about psychology next because, yeah, that's going to be the next troubles for you in the process.